Afternoon, good morning, good evening, good night, depending on what part of the country you're located at. This is Jasir Jamal from Texas 1031 Exchanges, located down south of the country, of course. So today, before I get into this video, please understand that every single video that I have published by far and that I intend on publishing, including this one, all the content that is being displayed and that is being spoken about in these videos is meant for educational and informational purposes only. Please do not consider this or construe this as any forms of legal or investment advice in any way, shape, or form. Please always do your own due diligence, consult with your own CPA, your own tax attorney, your own estate attorney when it comes down to 1031 exchanges, and never blindly listen to a random guy on YouTube. So, with that being said, let's go ahead and talk about what this video is going to be about. So, you've normally heard when you do a 1031 exchange, you're just deferring your capital gain taxes. But what if I tell you you're also deferring another set of taxes that you could face when you sell a property, especially when you took advantage of depreciation while you own that property, like how everybody does. And what exactly is that tax? It's called depreciation recapture. So, of course, the IRS will definitely charge you a tax on your capital gains that you make by selling the property. But at the same time, if you took advantage of depreciation while you owned it, the IRS is going to go ahead and accumulate that, and they're going to tax you on that appreciation as well. I don't hear that many people talk about it, but nevertheless, let's get into it and let me show you what it's all about. So without further ado, let's get into it. So, you have let's say you have, hold on, let me put my phone down real quick. I was going to use it as a calculator, but let me put it down so that I can work the marker. So let's say you bought a property for $500,000 back in 2010, no issues. And now in 2020, you're about to sell it for about $1 million. So now you folks can automatically see a capital gain of $500,000 that's about to come up, correct? But now let's calculate how the depreciation recapture is going to work on this. So look, you have, let's say you are, let me go ahead and get this in the way real quick. So for residential and for commercial. So for residential properties, I'm sure your CPA can always let you know that they calculate the depreciation based on 27.5 years. Because for a residential property, it can only be depreciated by 27.5 years. But for a commercial, it can be depreciated by 39 years. At least, this is what it was the last time I checked. So, let's just say this property is a residential property that you're selling over here. So how is depreciation going to work? So let's talk about that. So let's say this property, you bought it for about $500,000. You're going to go ahead and divide this value by 27.5 years, and this will go ahead and tell you how much you can depreciate this property every single year. So what is 500,000 divided by 27.5 years? And just know I'm going to round this answer up, but I'm not going to use any decimals for the sake of simplicity. So $18,181, actually $182. That's how much you can depreciate the property by each year. So you're just going to go ahead and depreciate it for the past 10 years, and you've owned it for the past 10 years. So we're just going to multiply that by 10, and it'll give you the total amount of depreciation that you have taken advantage of while you've owned the property, which comes out to be about $181,182. It's a lot of depreciation right there. So this is how this is going to end up working now. So you bought that property for $500,000, and throughout this 10-year period up until 2020, you have depreciated it in total by $181,000. So now in front of the IRS, this property is not worth $500,000 anymore. So now this property is worth $500,000 minus this total depreciation you took advantage of. What does that come out to be? Well, let's find out. 181, 182. That comes out to be about $318,000, 818. I'm so sorry. I'm so bad and trippy with the math right now. So this is what the value of the property now is in the eyes of the IRS, because you have depreciated it over the years by $181,182. So now your capital gain is going to be calculated using this. So you're selling it for about $1 million, right? and now you're going to subtract it by this number that we just calculated, which is the new value. What does that come out to be? About 1,000,000 minus 318,818 comes out to be $681,182. That's your capital gain now that you're going to be taxed on. But hold on a second. So we both, as we just calculated, agree that, look, $181,182 was depreciation that's being recaptured right now. And then the rest of the $500,000 is the capital gain that you've experienced. So both of them are going to be taxed at different rates. But let's talk about how this depreciation recapture is going to play out. So the max the IRS can tax you on a depreciation recapture is 25%. That's their max they can ever go. But this also depends on what income tax bracket you fall under. Unfortunately, I don't have their income tax rates for 2023 up in here, but let me put it this way. If you're somehow in the 10% tax bracket and you're making the certain amount of money to fall under that tax bracket, no matter how much this number would be, the IRS will charge you 10% of a tax on this depreciation that they're going to recapture. And then, of course, if you're in the 12% tax bracket, they'll charge you 12% for this. But then, of course, if you're in the 22% or 20%, they'll charge you 22 or 22%, depending on which one you're in. But then let's say if you're in the highest tax bracket for the income tax, which is 37% last time I checked, the IRS cannot take that number up to 37. They're going to have to max and cap it off at 25%. So there you go. And then this capital gain right over here, $500,000. Let's talk about how this is going to be taxed. I have the rates pulled up right here for you. In all my previous videos, you've heard me say depending on how much money you make, depending on what tax bracket you fall under, that's going to determine how much you're going to pay in capital gain taxes. Well, let's talk about it right now. So if you're single and you make up to or less than $44,625 a year, no matter how much your capital gain is, that capital gain is going to be taxed at 0%. And then that number is $59,750 if you were the head of household filing like that, 0%. If you're married and you're filing jointly, if both of y'all are making at or below $89,250, your capital gain taxes, no matter how much your capital gain is, would be 0%. And then when you're married and you're filing separately, it's the same number, $44,625, as for if you were single. But then now let's come up. If you're single, you're making $44,626 through $492,300 each year. You'd be taxed at 15%, which is usually the average tax rate people pay on capital gains because that's the normal income tax bracket they fall under. But then if you were head of household, that's $59,751 through $523.50. And then if you were married and you're filing jointly, it's $89,251 and through $553,850. And then, of course, if you were married and you're filing separately, it's $44,626 through $276,900. There you go. Then, of course, the max you can be taxed on capital gain is 20%. How do you fall under that tax bracket? If you're single, you're a successful attorney or a successful doctor, and you're making over $492,300 each year, your capital gains will be taxed at 20%. And then if you're the head of household, you're making over $523.50, you'll be taxed at 20%. If you're married and you're filing jointly, the number goes up to $553,850. And then, of course, if you're married and you're filing separately, it's $276,900. So no matter what your capital gains are, no matter how much it is, this is what's going to determine. If you make money above these numbers right over here, that's going to determine which one of these percentages of the tax is going to apply to your capital gain. So there you go. So for the sake of this example, let's just assume you're a single man and you're like a very successful doctor or successful attorney, and you're making over $492,300. Well then, you're paying 20% on this $500,000 worth of capital gains. So let's calculate that. So this 20% of $500,000 is what again? Ooh, that was wrong right there. Is $100,000. That's the tax you will pay on this $500,000 as your capital gain. And then for the depreciation, let's say since you're making about $492,300 each year, that puts you probably in the 37% tax bracket last time I checked. But for the sake of this example, we'll say you make enough money to fall under the 37% tax bracket. So therefore, your depreciation over here will be recaptured at 25%. What is 25% of 181,182? That'll be about $45,000 $102,295. We're just going to say that. There you go. So the total tax you're going to pay on the sale of your property over here will be $145,295 right over here. At first, your tax bill was just going to be $100,000, but because of that depreciation that you took advantage of, the IRS is going to tax that, and they're going to pull an extra $45,295 out of you. Brings your tax bill up by $45,295. That's pretty hefty, ain't it? Yeah. So, there's another tax I want to bring your attention to. So over here we have the net investment income tax rates. I always say net income investment, but it's actually net investment income tax rates. And that tax rate is always going to be 3.8%. And let me tell you how this works. So, of course, you make your money through your investments, and of course, after deducting all the legitimate expenses that are associated with those investments, you're left with a number down that the IRS is going to tax you on. And that number, I believe, is called your modified adjusted gross income. And the IRS can and will slap a 3.8% tax rate on that as well. If you are married and you're filing jointly, both of y'all are making above $250,000 as your modified adjusted gross income, the IRS is going to slap an extra 3.8% tax on that. Yeah. But then if you're single and you're the head of household, if your modified adjusted gross income is over $200,000, that rate will come up. And then if you're married and you're filing separately, if it's above $125,000, that 3.8% tax will be slapped on. Why did I mention this? Well, number one, that's another form of taxation right there. Number two, if you were to recognize this gain right over here, where is it again? Right over here. If you were to recognize this capital gain right over here with the depreciation included, this would count as your investment income. And of course, you would include that in your investment income. You would include that with all the other investment income you make through your other investments. Then, of course, after deducting all the expenses with those, the number would come down to, of course, these. If that modified adjusted gross income is higher than these numbers right here, you are going to be slapped on with an extra 3.8% tax. It's very hefty, ain't it? Yeah. But again, this is something that your CPA can definitely verify for you. And as I mentioned in the beginning of this video, if you were using these exact same numbers, this is not final what your tax could come out to be. Again, always run through your CPA when it comes down to this, because they will be able to give you the correct answer, as they are more familiar with every forms of the laws within your tax code. So therefore, that's it for me today, folks. I know this video was very long, but at the same time, I hope you guys got some very valuable content out of this. And these are the kind of taxes you could be exposed to. And how exactly can you avoid this tax over here and avoid paying taxes on this capital gain? Easy. Just do a 1031 exchange. If you do a 1031 exchange, you're not only deferring this $500,000 in taxes, but you're also deferring the tax on the depreciation that's being recaptured if you were to sell. So by doing a 1031 exchange, you're deferring both the depreciation recapture and the capital gain. And they will be deferred, and of course, if you continue doing 1031 exchanges, it'll just keep going that way, you know? But that's it for me today, folks. I really hope y'all got some knowledge out of this video, and if you have any more questions with regards to this, feel free to reach out to me. And until then, I will see y'all in the next video.